Hello learners, I am Dr. Reena Raj, Head Department of Commerce, St. Joseph's College of Arts and Science for Women, Hosur. Today we are going to see a new module on the topic Introduction to Insurance. The contents which will be covered are Introduction to Insurance, Meaning of Insurance, Definition of Insurance, and Features of Insurance. The world is full of uncertainties. People face different types of risk in their daily life. For example, many families are forced to live in penury due to the untimely death of the sole breadwinner. Many farmers have lost their crops due to flood and drought. Fishermen have lost their boats and nets during tsunami, and many have lost their lives in accidents, earthquakes, flood, war, fire, etc. It's not possible to avoid all the risk, however cautious we may be. These risks cannot be eliminated altogether, but can be reduced by taking some precautionary measures. The unfortunate victims of these risks cannot bear the consequent sufferings by themselves. Let's now understand the meaning of insurance. Someone has to bear the responsibility, and there is a dire need for a device or machinery or institution to provide necessary help to them, and such a device is known as insurance. The institution providing such a help is called the insurer or the insurance company, and the person for whom such a protection is offered is called the insured or the policy holder. Insurance is an arrangement under which the people facing common risk come together and make their small contributions to the common fund. Let's see the definition of insurance. This is the definition given by Justice Tyndall. Insurance is a contract in which a sum of money is paid by the insured in consideration of the insurers incurring the risk of paying a large sum upon a given contingency. Another definition given by Britannica Encyclopedia: insurance is a social device whereby a large group of individuals, through a system of equitable contribution, may reduce or eliminate certain measurable risk of economic loss common to all members of the group. We are now going to see the features of insurance. Insurance is a contract between two parties, the insurer and the insured. Insurance is always done for a consideration. What is the consideration given to the insurer? It is a premium which we give in the form of monthly or quarterly or half-yearly or annual installments. And what is the consideration for the insured? It is the sum of money which will be paid at the happening of any uncertain event. Insurance is a cooperative device. It means it's a group of persons who agree to share the financial loss, who may be brought together voluntarily or through publicity or through solicitation of agents. Insurance gives protection from financial risk. Insurance is a contract of certainty and contingency, which means that in the case of life insurance, it is a contract of certainty because the uncertain event is sure to happen. It may be either the death of the insured or it may be the maturity of the policy, whichever is earlier. And whereas in the case of other types of insurance, like for example, fire insurance or marine insurance, the amount is paid only on the happening of the contingency. Insurance cannot be compared to gambling because gambling may result either in profit or loss. Whereas in the case of insurance, the insurer has to indemnify the loss incurred to the insured on the happening of an uncertain event as stipulated in the contract. Insurance cannot be compared to charity as well because charity is offered to the poor or needy without expecting any consideration from them. But insurance offers protection to the insured's life and property only after getting consideration in the form of premium. Insurance is based upon certain principles like insurable interest, utmost good faith, indemnity, subrogation, causa proxima, and contribution, which we will be seeing in the subsequent modules. Insurance is regulated by law. In the case of life insurance, it is regulated by LIC Act 1956. And in the case of general insurance, it is regulated by General Insurance Business Nationalization Act 1972 and the IRDA regulations. Insurance is always based on the value of risk. That is, the premium is calculated based on the risk of the subject matter. Insurance requires a large number of insured persons because if an insurer admits more number of persons, the cost of insurance will come down and thereby the amount of premium also will be lowered. The amount which is collected as premium from the insured is invested by the insurer in certain types of investment, which gives either dividend or interest to the insurer. Thank you, learners. We will be meeting again in another module.